Welcome to the FML podcast, the podcast on a mission to uncover actionable insights, explore the latest trends, and to catalyze your FinTech's growth. Join Growth Gorilla's founder and managing director, Shamir Sajdev, and some of FinTech's hardest-hitting marketers and leaders.
Welcome everyone to today's episode of the FML podcast. Today we're joined by Amberly Jones, Head of Growth at Frec. Amberly, thank you very much for joining us today.
Yeah, excited to be here.
Let's just jump straight into it. Tell us about your background and what led you to join Frec.
I always kind of say I was born a personal finance geek, and as a young, high school student and in college, I was just obsessed with FinTech, all the new tools. It was back in the day when Wealthfront was groundbreaking. And so I kind of set out on a mission to get into consumer FinTech. And that has taken me a few different places, but mostly I've been in different roles that are pretty cross-functional leadership roles across sales, marketing, now growth at Frec, but mostly all in the consumer space. My last startup was called Realm, and that was a really complicated, high consideration marketplace business. Great experience. We were really focused on empowering homeowners to make more data-driven decisions because your house is such an expensive asset and most people just don't know what to do with it. But over the years, I was there for about 4 years, was really good, experience, scaled. But over the years, we became more of a marketplace and I got that itch to get back to more traditional FinTech, looking for something that's really groundbreaking. And that's how I stumbled upon Frec.
The best question to ask really is, what is Frec? What problem are you trying to solve?
Frec is direct-to-consumer platform, the first really to focus on direct indexing. Now, most people don't actually know what direct indexing is. So taking a step back, it is the more tax-efficient alternative to passively investing in the market via an ETF. Most people are familiar with ETFs, but it's basically you're buying a basket of stocks. So if you want to track the total US stock market, right, you could buy something like VTI. And in the ETF world, what you're doing is you're really delaying paying gains. So you wait until you sell that ETF. You're never having to pay capital gains along the way. But that has some limitations, mostly being that with ETF, you can't do any tax loss harvesting. And so there's been this strategy called direct indexing, actually for 20, 30 years, but it's been only available through expensive wealth advisors. So you have to pay an advisor 1%. There's various fees, but standard fee is 1% per year. And when you start to run the math on that kind of a fee, it really doesn't make sense for most people. The tax loss harvesting doesn't offset that cost enough. All of the technological advancements, right? Simple things like fractional shares, no commission trading, that is not the only way to do it anymore. So our founder, Mo, was actually getting pitched about this product by wealth advisors saying, hey, you should be direct indexing. You need these tax losses. And as he started to back into it, he was like, I actually think that we could just build this. So we're really focused on bringing the costs and the minimums down. So our fees start at just 0.1%, so a 10. And you can start with 20,000 versus when you were doing this through wealth advisors, the minimums used to be, $1 million plus. So really hard to access.
Totally understand the concept. I would say in the UK, there are sort of, we have sort of allowances for capital gains tax here in the UK. Similar sort of product probably wouldn't make sense unless you were making, I can't remember what the allowance is, but unless you were sort of in the tens of thousands of profits at least. Is that sort of similar in the US where, this product is probably geared more towards sort of the mass affluent, high net worth individuals, or, are the allowances different in the US? And so therefore it's actually quite, applicable to everyone?
Yeah, that's a great call out. You're right. So our product is, I should say, US based right now. The laws are going to be different all over. So if we expand, that'll probably be a very slow journey. In the United States, the way that it works is everyone has different tax brackets based on their income, but there's typical rules around basically capital gains. And tax losses, the way that you can use them is to offset capital gains. You can also offset $3,000 of ordinary income per year. But on the capital gains side, there's sort of two types of capital gains in the US. One is short-term, which are taxed at the same rate as your income. And the other is long-term, which have a reduced tax amount. But there is no cap on how much you can offset. So if I harvest $100,000 in losses and I have $100,000 in gains, I can wash that as a 1-for-1. The other thing that you can do here, which I'm not sure if you can do in the UK, is you can carry them forward. So let's say I'm a business owner and I know I'm going to sell my business in 5 years. I can actually accumulate those losses starting now and save them up. I don't have to use them in the current tax year. So direct indexing, while it was really good for people with huge capital gains and very high incomes, because of the way it works at a low fee structure, even if you're going to have a small amount of capital gains, or maybe you're going to sell your house for a profit, you can use the tax losses for things like that. And we did some recent research, which was pretty interesting, that also shows how it can just benefit you in retirement. So maybe you're not going to sell real estate. You're never going to have a capital gain until you're actually living off of your investments later in life. Direct indexing, when compared to just like doing it the ETF vehicle, can defer those taxes for many more years than if you were to do it the old way.
Is Frec the only place to do this? Other than sort of wealth advisors, are there other options for investors out there?
This is probably not the exact number anymore, but around 20 direct indexing providers. I think a few less than 20, and almost all of them require that you work with a wealth advisor. So you can theoretically do this at a lot of places, but there's 2 layers to it. Frec was the first focused on it going direct to consumer, but people are following suit. We think that's a great thing. More people need to know about this product. It's like there can be a lot of winners in this space if you think about all the dollars invested in ETFs. Wealthfront, I think I mentioned them earlier. They just launched a similar product. It's a more simplistic product, but it is a good product. And it's a low fee direct indexing for the S&P 500 specifically. And we think that more and more things like that are going to be coming. So there are a couple others where you can do this direct to consumer. We are the most hyper focused on it. Like that is just the thing we want to be the best at. We don't want to do everything else. We'll of course do some other things. But when I look at us like versus a Wealthfront or some of those other ones that do go direct to consumer, they're more of like an all-in-one type of shop. So they really want to be good at a lot of things. They have your checking account, they have your high yield savings account, all of those. And for us, it's like we want to bring these sophisticated strategies to the people, but we don't need to be really good at everything else. We just want to be hyper focused here.
And is that sort of the key way that you differentiate yourself?
Yes, I think so. Another way to explain that is like with using the Wealthfront example, you can direct index on 2 different indices, the total US stock market and the S&P 500. At Frec, we have 14 different indices. You can customize them. We tax loss harvest daily. We provide a lot of different, like I would say, like customization tools, like how you can reinvest your dividends, or if you want to be more aggressive with tax loss harvesting versus tracking the index. So we're really focused on more specific controls that put more power back in the hands of the investor.
As you're sort of speaking, and someone who's, pretty au fait with, well, I should be, with financial services and FinTech products, it does take a beat to sort of fully understand the capability and kind of what you're offering. Kind of having said that, there must be a degree of, I suppose 2 things really. Sort of the financial education piece that needs to be done to, to educate the audience and to get them to utilize your product. And then being a, financial product, that's sort of a new player to the marketplace, there's also building the brand awareness and the trust piece as well. So it would kind of be great to understand, like, how has Frec gone about, I suppose, building that brand awareness, driving trust, and then I suppose your approach to financial education as well.
You touched on, I would say, one of our bigger challenges for sure. So like one of the first things I did when I actually started at Frec, I knew the product. I've been tax loss harvesting in my own scrappy ways and like looking for something for personal use. So when I found it, I was like, this makes so much sense to me. But I went and started talking to friends and family about it, specifically the more affluent people in my life, assuming that they would know and understand. And like 1 in 20 was able to articulate to me what direct indexing actually is. So it became very clear to me, this is not just a new brand, right? This is a new product to people. And some of the people might actually be doing it through a wealth advisor and not even know, but most people just do not know what it is. And so what we've really focused on, especially in the last, 9 months, is really good content and research that allows people to kind of learn at their own pace, but also get deeply into the weeds. And I think with something like this, the first time you hear it, right, it's interesting, a lot of questions come up, but it's an overwhelming amount. So you're going to have to read about it and ask questions like 5, 6, 7 times, not 1 or 2 times. And all right, I'm going to go use this strategy. So it takes people time. So the biggest thing we've really been focusing on is content. And that spans, snippets, social media, us posting about our product updates, but it's also, more importantly, really deep research that we spend a ton of time on. So like on our website, we have white papers that go in depth on all the different pieces of direct indexing and how it actually works. And that's been really helpful and something that we really value and put a lot of time into. And then it's figuring out, all right, how do we pair that with the right, more traditional growth efforts to also get the conversion? Because it's like awareness of what direct indexing is, awareness of Frec, and then creating the trust and almost a little bit of FOMO of like, hey, don't miss out on this. There's a better way to what you've been doing, but it does require the educational piece, like short form advertising for us. That's not something that we are ready for.
Circling back to the question I asked around sort of target audience, what sort of wealth level Frec is suitable for, there's an element of, who can use the product, but then also an element of the acquisition cost versus customer value piece kind of crops up. With the amount of effort and I suppose resource you need to put into financial education, does that mean to say that you need to go for the upper end of the market? Or do you tend to find that your education piece is actually quite broad and it's working quite efficiently enough to bring in users across the entire space?
Yeah, it's a good question. I don't think I fully answered you the first time you brought it up. So I'll step back and say, like, who are we really targeting first? And yeah, I would say above average in terms of net worth for sure. But the main thing I like to say to people, like, who is this a good fit for? In the US, there's a bunch of tax advantaged retirement accounts, like a 401k, a Roth IRA. If you are able to max out those accounts and you have additional assets to invest, considering direct indexing is a great idea. So that inherently means you're probably, above average on income, probably a little bit above average on net worth. It becomes a slam dunk when you know you're going to have capital gains taxes. So, and that is usually like another notch up. We've done a lot of work thinking about, all right, like how much should we really be spending to acquire a customer? And we've actually backed into thinking of it as how much we will spend per like dollar in assets that get invested versus just like a traditional CAT calculation. And so, yeah, we're focusing on people that are higher net worth. Our account minimum for the direct indexing product is $20,000. That's actually not because we're trying to weed people out, but it's because to use the strategy, we have to be able to buy at least a fraction of every share within the index you want to track. So to really be able to replicate it. And so that minimum also naturally kind of weeds people out. So we wouldn't want to go, targeting people that may only be able to put in 5 or 10K because that's a waste of their time. It's a waste of our resources. So one of the things that we do a lot is think about like lenses, like who are the, not just in terms of like their net worth and their investment profile, but who are the types of people that like to use a product like this? Doctors, lawyers, tech employees, people like us, growth leaders, founders, of course. And so narrowing in there has been very helpful.
Talking about the avatars that you're targeting, now they're naturally going to be pursued by incumbents, wealth managers. It's a very competitive space, especially as you sort of I would sort of refer to it as a sort of a wealth pyramid. As you make your way up that pyramid, it becomes harder and harder and harder to a degree because everyone's sort of competing for that pound or that share of wallet. How has Frec, so I suppose two things really, built up credibility with that audience and then also combated, I suppose, a degree of skepticism or working directly with a platform versus via a wealth advisor?
Yeah. So I think of our investors, kind of two buckets of investors, even when you hit like a certain net worth. But taking a step back, if you have, 100 million, 200 million, like ultra, ultra high net worth, there's also that you might just not be the right fit. You may want a wealth advisor. It's worth that fee for you. But all these people in the middle, there's kind of two buckets. There are people that want to be self-directed and have control over their investing. Frec is pretty intuitively a good solution for those people. Like they don't want to hand the control over to someone else and they get it. So even though they could afford a wealth advisor or may benefit, they really like having the control. And the blocker to doing it on their own has been that the self-serve tools just are not sophisticated enough. So that group is really about, yes, getting the brand trust, making sure that they feel like they're going to be secure with us, but they're intuitively interested in this idea of having more power. The other bucket, which you kind of touched on, is the ones that are getting hit by wealth advisors. Maybe they already have an advisor, and there's definitely more layers to that. I do believe certain people are better off having a wealth advisor. The biggest thing I always say there is like, if you are going to be emotionally reactive to the market, like United States right now, the market is not doing well the last couple of weeks. And if that's going to cause you like so much fear and panic that you might irrationally sell, then a wealth advisor is great for that situation because they're going to protect you from those kinds of decisions. But within the people that have wealth advisors, there are still people that would be better off self-directed. So that part is a little bit harder to sift through. But the market size of just people that want to be self-directed investors that benefit from the product is big. And we definitely haven't like tapped all of that yet. So I think round two, as we've like gotten more of those, will probably be, all right, now people that are already with a wealth advisor, how do we kind of walk them back?
I think Vanguard and the other ETF players have done a great job particularly in the US, and we're seeing it happen here in the UK now and Germany as well. They've done a great job of really elevating people's awareness of ETFs and investing directly into an ETF versus, just taking punts on Robinhood. And we see that now. There's a few platforms in the UK that specialize in that space that are doing really, really well. And they're picking up the share of wallet from what we call cash ISAs. I think in the US, you have Roth IRAs, which are quite similar. So there's sort of like a yearly amount that you can invest, put cash in, it's a wrapper, and you can invest in sort of tax-free. You have a choice in the UK between cash and then stocks and shares. And we're seeing a lot more movement now from the cash piece into the stocks and shares piece, which was almost non-existent, 5 years back. So yeah, it's super interesting. Kind of want to sort of jump into the real acquisition piece. I think we've kind of touched upon it a little bit, where you've talked about sort of producing this content, white papers, and then sort of nurturing your audience through that journey. And I suppose we've somewhat touched upon the fact that because Frec is, I suppose, arguably high consideration, you have to have multiple touch points. I think sort of the layer above that is, what are the levers that can be pulled, or what levers do you pull at Frec to try and sort of drive and turn on the taps for acquisition?
I really think of it as like, what are all the ways that we can kind of create social proof and borrow trust? And that is what has worked really well for us, especially in this like first year and some months out of stealth, being so new. And so it's, what are all these different people, places, communities, groups that we can be a part of and borrow trust from? And that's worked really well for us, paired with the content. So we look for organizations that already have the trust, the type of investors we're attracting. And sometimes that's communities really geared towards certain professions. Sometimes it's investment groups where people just already are going to talk about money. Reddit is really big here, and there are lots of subreddits where people just have a high level of trust. And so working through other organizations and getting them to kind of test our product and have, if there's somebody running a community, getting them on the platform and then working with them. What is a series of educational things we can then do for their community when we've showed them that Frec is a great product, like webinar series and getting those white papers out into their hands in more customized ways. But I think this borrowed social proof idea, or borrowed trust, has been the most impactful lever.
It clearly sounds like you've done a fair bit of sort of experimentation. What channels have you tested, and what sort of surprising insights have emerged from that testing?
So we have tested quite a lot. And I will say, when I think about growth experimentation, it's not always like, does this work? But it's also, is now the right time to make it work? I say that because there's stuff we've done that I'm like, yeah, it's not working for today, and I don't want to put more resources in it, but it doesn't mean it won't work for us later, or we shouldn't revisit it. And the cadence in which we revisit things, maybe it's a midterm revisit, maybe it's not for 3 or 4 years, but it's still on the table. And then there's stuff that just purely doesn't work. The best example of a failed experiment recently is just paid in general. And this goes back, I think I sometimes sound like a broken record because I'm like, it has to be long form. But whenever we do like a short ad, whether it's Meta, Facebook or Instagram or LinkedIn or Twitter, the short form ads just don't do enough of the educational piece to get the click through. So we put dollars behind it, and what we would end up with are a lot of low value accounts that didn't really know what they were signing up for, and very little high value accounts. And from past experience, I think for us to actually crack that, it's like such a huge body of work. I don't think it's the right time, because I think it makes more sense for us to focus on the brand building, the trust building, and all of the other channels at our disposal. But will we want to revisit it one day? Absolutely. Traditional performance marketing has not been working as a result of our experimentation. Now, there's other groups, like I talk a lot about this like community idea, and that can be so many different things. Influencers is a good example. Some influencers are really good fit for us. Most of them are not and do not work. So that's like its own science, right? All right, we figured out that we can borrow trust from certain influencers. What is the playbook for that? And that's required its own type of iteration, trying things with a bunch of different types of people and figuring out as quickly as possible which ones have signal to keep investing in. And then on the community side, we saw really good traction with this community. It's called Long Angle. They're awesome. Like for anyone that's looking for a place where you want to be talking about investing with other high net worth people, it's a really cool community. That kind of inspired us to, okay, what are all of the other lookalikes to this? We got some traction. This is such a great one. And then it unlocked this whole concept of that we call it like this professional vertical. So now we're going after all the places where doctors go to get educated, not just on medicine, but on how to build wealth and have a good life. Like there's so many of these types of communities. And that kind of we're following suit. Like what's next? It's lawyers, it's dentists, it's all these things. And so that kind of signal just from like early influencer persona and our first community is unlocked where we're now putting most of our focus. And the failures really is more of like a learning on where to prioritize. So it's like good that we were able to rule those things out, but we'll probably want to revisit many of them.
I'm a big advocate of influencer. I think what's really interesting is that, you've talked about, there's certain types of influencers that work for you and then sort of the verticals as well. We've seen that, with our clients as well. I think the immediate sort of go-to is working with finfluencers because they speak obviously about personal finance, etc. But we've seen it as well where when we start sort of, we call it so it's a bit like a marketing onion, right? You start from the center, with the real sort of high intent stuff, and then sort of working your way out and you can start sort of focusing on peripheries. So yeah, speaking with, influencers that speak to the medical professionals, that's a really interesting approach to, influencer marketing. And I think that's probably overlooked by many, truth be told. Sort of working our way through the funnel, one of the things that I'm aware of is that you've also added a sales layer into your onboarding. As a fintech, that's actually quite unusual. I have a personal opinion on this, and I'll mention it afterwards. But how did you sort of move to that? What was the thinking behind that, and what's the impact been?
Part of my background, and I don't know how much I emphasize this, but I have spent a lot of time running large sales teams. And it's funny because early in my career, someone asked me, like, what do you want to do? And I was like, I don't care, but I'm not doing sales. And that is because I had such a bad understanding of what sales is. I thought of sleazy car salesman, you won't stop calling me, you're being pushy. But then as, kind of time went on and I saw examples of excellent sales, I realized that if you are a good seller, what you really are is an advocate, a coach, an advisor. You're figuring out what's in someone's best interest, and then you're helping them get there. If it's not in their best interest, right? Like if our product is not in their best interest, it is our duty, regardless of being a fiduciary, but as being like a good salesperson, not to continue pushing them down this road. So I always just like to clarify kind of my stance on sales before going into this question, because if you're looking at it from a different perspective, it can be like alarming. But the other side of that is like one of the greatest failures I've seen across different marketers or people running growth teams is not looking at the full funnel and taking that full funnel approach, right? If you are just focused on getting traffic to the site, or you are just focused on the traffic to sign up conversion, you are not understanding the real quality of that lead. You really need to be looking at how it's going to move through every stage. And that includes like churn, right? If a customer's been with us for a year, it's still important that they're happy and they're not planning to leave. But many people get too siloed, I think, into the part of the funnel and don't realize the actual implications or the value of a given lead or a given customer because of that. And then early stage like this, I think long-term, Frec absolutely, like we are product-led growth. We want this to be seamless self-serve for people, everyone to come in with enough trust that they never need to or feel the pressure to talk to a human. But as we're early and we're figuring all of that out, and because it is a high consideration product, we want people to be available. If you have questions or if we can add value for you, we are happy to jump on the phone. We're happy to walk you through this. And if it does make sense and it is a good fit, how can we like help you execute it? Make sure it doesn't just get lost on your radar. Life is busy. People are just forgetful. So having a human help also kind of keeps us accountable to our own goals in certain ways. And so kind of more specifically to Frec, as I started building out the plan, one of the big very evident opportunities for me was just this, like people that have created an account, but never funded, never talked to us, like never done anything else. And so I was like, what is the easiest way without having to build 30 things and distract the engineering team to get a better understanding of why people are stopping there and moving them forward? And so that's where this kind of, I would say it's also a light sales layer, but that's where this layer came in, and it's adding basic touch points, making sure that when someone signs up, they know we're here to help them and that we're happy to jump on a call, just really making ourselves very available. And the people that do that have to be amazing and true product experts. So the actual people, it's licensed fiduciaries, they're acting in the customer's best interest, but it's really there to answer these questions. And a big part of that is like the minimum, $20,000. It's not like you can put in $500 and see if the product works. So you might want to ask questions like, hey, how do I know I'm going to get similar returns to the ETF? We can say that on our website, but a human actually pulling up different accounts, showing you that, it's like, oh, okay, great. And then you're like, all right, I'm going to put this 20,000 on, but now I know you, John, Amberly, I can call you if something goes wrong. So it's a little less scary, especially with some of the big fintech failures in the last few years, for people just to know there are actual humans here that are ready and excited to help you in the way that is best for you. Launching that has led to big conversion improvements. Like I would say, dare to say, like step change growth in those numbers and really good feedback. And we are always very careful. Like the second somebody is like, hey, don't call me, or I don't want to talk to a human, I'll let you know if I need you. We are respectful of that. It's a hard stop for us. So I think the approach to this is really, really important, but it has been very beneficial.
And not too dissimilar from yourself. Prior to obviously the agency, I when I was marketing director, I was also sales and marketing director, so I looked after the sales team as well. And it was one of the biggest things that helped drive our growth in on two fronts: the conversion piece. All of those dormant accounts there, people sign up but not funding, not say. It's also gives you an idea how old I am, because we didn't used to have online KYC, right? They had to send their documents. So anyway, we'll brush past that. People sending in their documents to get approved and whatnot. But then there's also the reactivation piece as well. So people who had invested, traded with us, and then gone dormant, getting them active again and getting them using the platform. And a lot of that, what we found was actually they were happy to use the product, but they ran into a bit of an issue, a friction point, and there wasn't anyone there that they could speak to. Customer service can only do so much. And I know there's a stat out there for every one person that complains, there's another like 4 or 5 who had suffered the same problem, but haven't complained. And I think it's the same as, someone who calls up for help. There's probably 4, 5, 10 who haven't. And we that was a big driver for us in terms of growth. I think the other thing as well is it also massively increases the value per customer as well. Because as you start to create that rapport and relationship with that user, they start trusting your brand more. And what we used to do is we used to have a 30-day window. So it wasn't like the salesperson closed the deal or got them to sign up. They had 30 days to walk them through the process so they could nurture that relationship. And our funding amount went from like $2,000 in the first 30 days to like 4,500 for trading accounts. It's quite significant. And that had a massive impact. And like you, I think sales is the unfair word. I used to call them a business development team because it sounded a bit softer. But whatever it is, I think it's, a degree of relationship management.
Totally.
And so, big fan of that.
I was nervous to hear your hot take, but we're in alignment, so I love it.
Yeah, I'm all over that. And I just think sometimes, you got to nudge people. It's not their priority all the time. They're dealing with 9,000 other things, and it's just, getting them to make it a priority is great for your business, but it's also great for them as well if you've got a great product.
Definitely.
I'd like to really just touch upon sort of the product, I suppose, product innovation, milestones. It'd be great to kind of understand some of the new sort of product features that you've released, and I suppose, what's on the roadmap.
A couple of the other things that we currently offer. One, we have a portfolio line of credit that we've actually had for quite a long time, but it is unique. It's one of the lowest rates that you can find, and it's flexible borrowing. So instead of selling, the stocks within your direct index, you can borrow against them and use it for whatever you want. Flexible payback. We have a cool like margin loan, basically risk estimator, so people can really understand if I take out this much, when would I potentially have to trigger some type of a payback or sale? And people love that product. I love that product too. It's so nice, like even with tax season coming up, I'm like, well, I don't want to sell anything. I'm probably going to have a bit of a tax bill, but I'll just use my PLOC and pay it back. So that's a really good one. We also have a high yield treasury. So it's similar to a high yield savings backed by US money market funds where you can park your cash and just earn interest on that cash. And then we recently launched a portfolio allocation tool, which is really neat. And I don't think anyone has one quite like ours, where you can go in and basically decide if you want to implement like a reoccurring deposit and you want to make sure that you stay 50% in the S&P 500, maybe you want to be 30% total stock market, and maybe you want 20% going into your treasury, you can actually set all of that up within your account so that one reoccurring deposit is dispersed how you want it. And we make it so that you're not going to be forced into rebalancing either. So that tool, the idea is just kind of, our goal is always to put more control back in the hands of the investor. And this one is really doing that. It's got great feedback so far. There's a couple of things that are kind of like table stakes to us, really cool products, but we're just like, we have to build these. One is on the sake of portfolio allocation, like people need fixed income products, especially as you get closer and closer to retirement. So we will launch some fixed income this year so that if you have your treasury, but you want actual bonds, like that's an option. is just important and through the lens of allocation. But there's also a strategy called long short. So there's direct indexing, but using both short and long strategies, which allows you to harvest even more tax losses, which is very powerful for people that are going to have large windfalls. So especially for people like founders or even early employees that are going to cash out or their companies are going to go through an IPO, that allows you to harvest tax losses much more aggressively. So we want to build that. And then, of course, we are thinking about crypto. In the US today, there's a lot going on. We'll see what happens. There's like talks of no capital gains tax on crypto. I mean, it's hard to know what to take seriously and what not to. So we'll see. But there is actually no wash sale rule for crypto. So in the US, I don't know about the UK, when you're harvesting tax losses, let's say I have Apple dropped in value. I'm going to sell it to capture my tax loss. I have to wait 30 days to buy it back, or that sale is like washed out. I don't get to use the losses. With cryptocurrency, that rule does not exist. So if I own Bitcoin this morning at 85,000 and this afternoon it's at 74,000, I could sell it, capture that loss, and I could buy it back 5 minutes later. So depending on, some of the evolution there, we are really interested in building a tax loss harvesting product for crypto.
I suppose to a certain extent as well. I mean, the US scale is so big, that you've got such a deep market to grow into. That the opportunity, I suppose, at the sort of stage and size you are is almost endless. No, fantastic. Emily, it's been absolutely fantastic speaking with you. Before I let you go, though, I'm going to take you through our quick fire round. What podcasts are you listening to at the moment, or would you recommend to our audience?
Okay, it's a for fun podcast that I just recently got back into, and it's called Armchair Expert. They specifically have one called Armchair Anonymous, where it's like crazy stories from random people that listen to their other podcasts, and I'm obsessed. Best commute podcast.
Amazing. And what's your favorite fintech brand, app, company?
So favorite might be the wrong word, but something I'm very interested in watching is this company called Arch Public that has these different algorithmic trading. I don't use them, so I'm not saying like go do it, but it's fascinating and I very well might.
Great stuff. Emily, it's been fantastic having you on. Thanks for joining us today.
The FML podcast is brought to you by Growth Gorilla. To find out how our marketing growth experts can boost your fintech's growth, head to growthgorilla.co.uk and make sure to search for the FML podcast in Apple Podcasts, Spotify, or anywhere else podcasts are found. Don't forget to click follow to ensure you don't miss any future episodes. On behalf of the team here at Growth Gorilla, thanks for listening.